Good morning from Los Angeles. Welcome to Power Hour. This is going to be a good one today, folks, for the reason just the thumbnail kind of spelled it out. When I have my hat backwards, that means it's active. That means stuff is happening. That means I need to pay really close attention to what's going on. So, thank you for showing up. Thank you for the support. Channel is almost at 1,000 subscribers, so please give me a thumbs up. Supposedly helps the algo. Share the links, get me over 1,000. That would be awesome in a couple 3 months. Like I said, I'm not doing this for YouTube. YouTube is YouTube. The money on YouTube is as up and down as anything else, honestly. So we had a very active week. Market is eating it. From making all-time high after all-time high day after day, when the sell-off comes, when everybody is holding the same stocks and they decide to all sell at the same time, or it's like musical chairs, right? There's only one chair left, or somebody in a crowded room yells fire. What happens? They all try to run through the same door, and then it adds to volatility, which I will hit upon when I'm doing my watch list. I actually put out a cool video, but nobody watched it. It seems like it's about the VIX, the volatility index. You guys should go check it out. So I'm going to do the usual, the few topics. If you have questions, please keep it for the last 20 minutes or so when I'm doing my watch list, and go through the stocks of the week and action of the week. And then please share. I think I'm putting out really decent information. I mean, I do watch other people's YouTube stuff. They're all talking about their glorious trades in this. I mean, I have a few of those, obviously, over the last couple of months. But then, there are some losers as well, which I will always talk about. Because if somebody's saying that they're always, having profitable trades, although I had one trade that I gave you guys about a month ago, not even, on this little robotics company called Serve Robotics. Stock was $2, just hit 16 today. So all you had to do is buy 100 shares, and look where you are. Would I buy today? Absolutely not. But then I'm going to show the chart and talk about it. So anyway, without further ado, let's get into. So now that the market's pulling back, right? What should we do? I mean, do we sell everything, go away, come back, trade it? No. I think, it's never too late to start investing, to start with investing. I said not trading. So I'm going to talk a couple of topics about investing, long-term investing, passive investing versus active. And I think you guys will benefit from it. But it's never too late to invest. On these pullbacks, it's actually a pretty decent opportunity for you guys to get in there. So passive investing versus active investing. I mean, passive investing has become very fashionable over the last decade, after the proliferation of ETFs, exchange traded funds, which you can get in and out with very, very low costs these days, such as the SPY, which follows the S&P 500 index, or the triple Qs, QQQ, which follows the NASDAQ 100, where all the action has been over the last year or so. But on a long-term basis, dollar cost averaging works. If you are an investor, trader is something else. Even if you put $100 a month into some brokerage account, right? And then at the same time of the month, buy one of those ETFs. With compounding, it would be really, really decent amount of money in a few years. You guys have to have a long-term perspective when you're doing dollar cost averaging. It's called DCA. So what you do is you will have maybe a trading account, and then you will have a investing account, which I have. So in the investing account, you're buying things to hold for long-term growth. In the trading account, you're more aggressive. You're trading in and out, obviously. I don't day trade, I swing trade or position trade. You establish positions, you trim positions, you risk manage. Those are different things. But over the last 150 years, what has done the best? What investment, right? It's been stocks. Obviously there have been many, drawdowns or some crashes, right? Such as during the pandemic. But every time you get one of these 10, 15, 20% drawdowns, if you're dollar cost averaging, it's not going to make any difference to you, right? At some prices, you're going to buy it at the low. Sometimes you're going to buy it at the high, but all you're doing is creating a nest egg, creating this fund that will grow, and you reinvest the dividends, obviously, which I'm going to talk about the next subject. Because what should we do now? Should we play defense, or should we dollar cost average? I think a lot of people, when they get into active versus passive investing, they kind of mix it all up, right? They get into ETFs such as SPY, the spiders, or triple Qs or IWM, and then they decide to trade it. Well, no. I mean, if you want to trade it in your trading account. Don't commingle everything, separate things. But I think over the last 50 years, 100 years, if you dollar cost average, it would have done marvelously for you. However, the ETFs have only come around last 15 years, 20 years, right? So, but today there's an ETF for everything, exchange traded fund. There's an ETF for Bitcoin even, right? So maybe you should be dollar cost averaging Bitcoin, which I'm going to talk about on the last subject. To me, it's the key to long-term nest egg building, long-term wealth building. You can't just go say, well, oh, look at NVIDIA, I'm going to buy it here, sell it here, because, a hummingbird, and you jump from flower to flower. It says there's a time and space for that, okay? But then, ultimately, long-term wealth is built by buying and holding by dollar cost averaging, okay? I mean, perfect example would be what? Warren Buffett, right? Now, is his style my style? Absolutely not. Right? Am I more of an active trader? Yes, I am. The reason for that is these benchmarks that people have created, such as the S&P 500 or the triple Qs, on average, they go up 8, 10, 12% a year. On average. There have been down years, there have been up years, but if you DCA, you're not going to worry about that. So my point is, most mutual funds out there, I would say a majority, maybe 90+% of mutual funds, cannot beat these benchmarks. So if you have like a 10% return, there is also something called Rule of 72, which you guys need to pay attention to. Rule of 72 is whatever return you're getting on your investment. It could be real estate, it could be stocks, it could be individual stocks, it could be ETFs. All you have to do to figure out how many years it's going to take for your money to double for that initial investment, and then the compounding comes into play, obviously, is you take the return that you're receiving, right? Let's say 10%. What you do is you take 72 divided by 10, and that's 7.2. That means every 7.2 years, that initial $100, let's say a month you put in, is going to double. There is no ifs and buts about it if you're receiving, on average, a 10% return. Now, think about it. The next month, every month, you're putting $100 away, $200 away, whatever you can afford, right? But start investing. That's the key. And a lot of people mix it all up. They go like, yeah, but what if the S&P falls, 30%? Yeah, it has happened before, right? But then, you guys must also understand what's happening economically, the bigger picture, obviously, the macro, the micro, and the most important thing, you guys have to understand that the Federal Reserve, which I've been talking about it endlessly for the last 2.5, 3 months since I started the channel, they cannot afford the market to go tank. Right? Everybody's 401k, everybody's pension plan is in stocks. So what they do is when the tank happens, like it happened when? Last one, pandemic, right? 40%, 35% drawdown in the S&P 500 and the triple Qs. What did the Fed do? Fed starts the printing machines, and then they come support the market, right? So my idea about this segment is start investing. And for most people, your success is going to be, yes, there will be people, I'm one of them, that they will beat the benchmarks. But most mutual funds or most people cannot beat the benchmarks. And at a low cost, you can dollar cost average and, steady as you go. That's what you have to do. You have to understand long-term growth. Long-term wealth is built by patience and dollar cost averaging. Active investors did really well when hedge funds were coming around, right? It was new 20 years ago, 15 years ago, but then they would charge 2 and 20, 2 meaning 2% of management fee and 20% of your profit. Even today, hedge funds are having trouble beating the benchmark. So why not, right? Why not dollar cost average, start a little investment fund, investment account, and then continue doing the same thing. So with that said, please pay attention to the power of compounding and pay attention to dollar cost averaging. And you should do it religiously, meaning you put the $100 in every time at the same time of the month. You just go buy the SPYs or the QQQs or the IWMs or whatever ETF you think is good for you. You should do that. And so on the next topic, I'm going to expand this a little further with what's going on in our markets. Okay. There are things called high dividend stocks, right? What are those? A lot of the consumer cyclicals are high dividend stocks. Okay. So you have to also understand where our interest rate picture is. We had ZIRP policy for 15 years, since 2008. Well, all the way 2008 to 2022, after the great financial crisis, the Federal Reserve decided to keep the rates at zero, literally zero. Okay. And then what did that do? 15 years of easy money, free money, pumping, the printing machines, what happened? We created man-made inflation, right? And what's the definition of inflation? Definition of inflation is too many dollars chasing too few goods. And look what happened, right? We've been experiencing inflation since 2019. Everything we touch has gone up double, or if not more. So then what's the antidote for inflation? That it was man-made, right? Now, am I blaming the Fed? To a point, yes. I think 15 years of zero interest rate policy is too long. However, there are black swan events like happened the pandemic. Nobody anticipated that, right? In fact, the Fed was talking about, lowering the balance sheet after the 2008 financial crisis. But it seems like every 10, 15 years, there is one of these black swan events. And the Fed steps in, prints the money, adds to the money supply, supports the economy. The reason is we don't manufacture anything. We are a service-based economy. We used to be a manufacturing economy, but now we're service-based. 80% of our economy's GDP is made up by consumer spending, meaning we have to borrow and we have to buy stuff. Most of the time, the stuff we don't need. However, my point in all of this is when markets start drawing down on the first topic, like I talk about DCA, dollar cost averaging, doing certain, rainy day funds or investment accounts. Now, I'm taking this a step further, right? So why not? I mean, yes, the high dividend or high dividend paying or yielding stocks or ETFs are not going to give you the return probably of the S&P 500 on a nominal basis, meaning the appreciation may not be there. The appreciation may only be there 3, 4, 5%, because they're companies like, let's say, Coca-Cola's and consumer cyclicals or pharmaceutical stocks. Like most of the time, those have, or some bank stocks or some oil stocks. So, but then there are ETFs that are created to have a bucket of these stocks in there, and they get an average yield return. Some of them are as high as 7, 8%, right? Now, here's the deal with this. If you're going to dollar cost average, you should also look into high yielding stock ETFs. The reason for that is, I'm going to connect it to the Fed's policy of zero interest rates. During zero interest rate policy, these high dividend paying ETFs did extremely well because they're paying you 6, 7%, right, in dividends, and the bank interest rates are zero, right? If you go put in a CD, you were getting nothing, or a money market fund. What were you, 0.1%, right, or savings account? So what happens? Those stocks do very well in a low interest rate environment, or those high yielding dividend ETFs. While when the rates were pushed up to kill inflation, right, the man-made inflation that we created, what happened to those stocks? They all tanked because now you have a competitor in the US government issuing you or CDs or money market funds giving you 4 or 5% risk-free, because stocks, believe it or not, even with a high dividend, they're a business. If the business goes south, stock is going to go down, obviously. But so now there's a competitor. Now these high-paying, high-dividend yielding stocks, ETFs, did not do well, while what was doing well? The Mega 7 was doing well. The S&P 500 was doing well, right? By the way, the S&P 500 has about 2.5% dividend yield, maybe a touch under. So, but going back to this, the high-yielding ETFs, you can also look into these now. The reason for that, the reason I'm saying that is because I think we're going to go into an interest rate lowering policy coming up, most likely starting in September. So during zero interest rate policy, these ETFs did extremely well, right? Now that the Fed is thinking, okay, we need to soft land this economy, we need to start lowering rates, because all the indicators I'm watching are yelling, screaming recession, right? From housing, from credit card defaults, from car loan defaults, from mortgage defaults. They're all going through the roof at the moment. And for that information, by the way, we talked about that in the past shows. You can go to FRED, F-R-E-D, Federal Reserve, I forgot what it was, but data. Anyway, FRED is FRED or federalreserve.com, and then you guys will find it if you want to follow some indicators on the macroeconomic situation. So now that they're going to lower interest rates, these ETFs are going to do really, really well, right? And remember the rule of 72, right? If you're going to get 6, 7, 8% dividend yield on these stocks and a little bit of appreciation, okay, you may get over 10%. So, your choice of DCA is double fold now. You can do indexes, and then you can do also these high yielding ETFs. So what to look for to invest in dividend ETFs, high yielding? A dividend ETF typically includes dozens, if not hundreds, of dividend stocks. Absolutely. It's like a bucket, right? That instantly provides you with diversification, which means greater safety for your payout. Even if a few of the fund stocks cut their dividends, the effect will be minimal, and the fund's overall dividend will stay the same. So how do we look for these things, right? Obviously, Google is your friend. You can Google it. I'm not going to give you guys specific names because that would go into financial advice. So we'll pass on that one. So find broadly diversified dividend ETF. You can typically find dividend ETFs by searching for them on your broker's website. Sure. Broker meaning, Schwab or Robinhood or Ameritrade or whatever, right? And once you find your ETF, right, analyze the ETF. Make sure the ETF is invested in stocks, also called equities, right? Not bonds. Now, there is high-yielding bonds as well, but then in an economic slowdown, you really want to be careful with high-yielding bond ETFs, because if what happened to bond ETFs is they got killed, right? When the Fed raised the rates from 0 to 5, bonds. So bonds and bond values and interest rates are also an inverse relationship. So if the rates go up, the bond's value will go down. Like every bond is $1,000. Okay, so if an interest rate goes from 0 to 5, the bond's nominal value will go from, let's say 20-year bond, it will still mature at 1,000, but it will go from 1,000 to maybe 800. So you're eating on that part. So we're not talking here high yielding bond ETFs. We're talking high yielding stock ETFs, right? Check out the dividend yield. I've seen as high as 8, and I've seen, the average is about 5.5, 6 these days, which is above the 20-year bond, right? And with a little bit of potential growth you have in there, I think they're pretty decent returns. Look at the past, obviously, performance, but does not guarantee. But then you have the dividend safety in there, right? 5-year returns, 10-year returns. The expense ratio has to be really, really low, so you have to pay attention to that. Like on the spiders, the expense ratios are really, really low these days. I mean, they are definitely less. It should be definitely less than 0.5, preferably like 0.2 or lower. And then obviously AUM is important. It's called assets under management. I mean, how big is the fund, right? And the bigger it is, the better it is, the more diversified it is. And then you just simply go buy the ETF, and you can DCA into this as well. So now that the market's on a drawdown, okay, market's down. I mean, on triple Qs is down about 10% last time I checked it, or 9%. On the S&P 500, about 5%, right? Do you play defense? Do you start doing this? Well, what I'm doing with my own money, with some of it, is now that I see interest rates going back down again, right? These stocks will do better in these funds, and then the value of the dividends that these ETFs are offering you are going to be also more valuable, because the competing interest rates environment is more positive for them. So interest rates are going, if the interest rates are going to get cut, and the guessing game has begun, everybody's saying, oh, November, but I think it's going to be earlier than that, because I think the economic data that's coming out is horrible. So they're going to be forced to start lowering interest rates. They were supposed to cut interest rates 3 times this year. Now they're down to 1, but I think it's going to be 2, and the forecast for next year is 4 interest rate cuts. Now, you guys also have to understand, Fed does not cut the interest rates unless the economy is slowing down, okay? The reason they're doing that is because they're trying to do soft landing. This thing, it's like 747 soft landing. I don't know, on a little strip is not going to work out. We don't have that much luck, but they will definitely start cutting rates. So these high-paying dividend ETFs are going to be looked at more favorably. Again, don't forget the rule of 72, okay? Slow and steady is the way the game should be played. So that's the second topic. The third topic that I'm going to talk to you guys about today, what's happening. I mean, I did a couple of really decent videos about this in the past. Home affordability index is crashing in this country, right? What has happened? Due to the inflation that we created, right? We are in a horrible position for people who are starting their lives, let's say a couple of 30s, to go buy a home. Home affordability index has been the lowest in the history of this country. But now that lack of affordability is kicking in. How's that kicking in? It's kicking in the home inventories, used and new home inventories, going absolutely through the roof. New home inventory in southern U.S. officially above 2007 levels. So what's happening is that, builders have to build. I mean, they have the land. They made plans 5, 6, 8 years ago. They just build. Well, but when the affordability index is going this way, well, one of the main reasons the affordability index is going this way is because of interest rates, right? When we had the ZIRP policy, zero interest rate policy, mortgages, 30-year mortgages were like, I don't know, 3.5%. I've seen it as low as 3, but let's say an average 3.5, 4. Well, now the same mortgage is 7, 7.5, because they raised the rates from 0 to 5. Well, that's a major part of it, right? But the other thing that has happened is the prices. Because of inflation, right? I mean, one of the inflation hedges in my world is hard assets, right? And what has happened? Home prices have gone through the roof. The average home price in the country right now is $400,000, median price, $400,000. It's insanity, right? And then with the higher mortgages, the servicing of that debt is not easy, even if you have a 2-income household. So my thing is, I'm seeing a definite correction in home pricing. Now, I think the affordability index is actually going to roll over and start getting better. The reason for that is, on the previous segment, I talked about lower interest rates. Well, when they start lowering the interest rates, what happens? Mortgage rates start to go down. And conversely, the affordability index is also going to improve, right? So it's going to be a buyer's market going forward. The reason is, look at the inventory of homes that are not being sold. One, for the affordability index, and two, the supply keeps coming, right? And to me, I think the balance is going to get normalized. It is going to take like some time, absolutely will. But if you look at all these lines on the chart I put up, in the South, we're at the 2007 level. In the West, we're literally at the 2007 level. The only place, because the affordability is still decent there, is the Midwest and the Northwest, because the prices have not skyrocketed like that. But I know from West Coast, right? I mean, ridiculous, right? Every house now in California is like, the median home price in California is $800,000. How can you afford a house for $800,000 even if you're making a couple $100,000 a year? You can't. You really can't. So, you know, there are over 450,000 new homes for sale in the southern U.S. Southern U.S. meaning, you know, Florida's and Texas's, right? And so on the new home front and the existing home front, right, the inventory is building. So when the inventory builds, what happens? It's like supply and demand. Well, the sellers have to start adjusting pricing. So that will help the affordability index. The second thing is rates are going to start backing off. That's going to help the affordability index. But then it's going to take, this cycle is going to play itself out by reduction of home prices. I mean, I'm not calling it a crash, but there definitely will be a reduction of home prices, specifically in the South and the West, to the tune of probably, I don't know, 10, 20%. And if you're in the market to buy a house after a few rate cuts, when the mortgages go back to maybe 30-year mortgages go back to, you know, 5.5%, after 6 anticipated rate cuts by the Fed by the end of next year, and the prices, you know, correct a little bit, I think that will be a good time to buy a house. If you're thinking of buying a house, probably by the end of next year, you'll have a better chance of, you know, getting a roof over your head. So that's that topic. On the next topic, I'm going to talk to you guys something near and dear to my heart. Pictures 1,000 worth. I had amazing mentors over the last 30 years. But then initially when I first started working as a runner, literally one of those guys, well, not one of those guys, but I look like those guys in the back there, right there. As a runner, literally running paper to these people to do the transactions. They're called runners in the World Trade Center, which is not there, obviously, sadly. But I had like amazing mentors, and I think that's what you guys should do. So I'm trying to be that mentor to you guys. You know, I never forget a lot of the advice they gave me, even today, right? When I'm in a trade and I'm doing one of these, as professional as I am, once in a while, I'll still do one of these. When you do one of these, the mental, the financial, well, financial first, obviously, the physical, the mental aspect of this is horrendous. Now, you know, this is called don't catch a falling knife. Okay. And my mentors used to always say that to me. They go like, they would say, it's never too late to sell, and don't catch a falling knife. Wait for things to settle down. Their markets open every day, Serge. You don't need to be a jockey. You don't need to participate every single day in what's happening, but don't do this. Because, so think about this. You have a very sharp blade, okay, that you know will slice and dice you, all right? So what are the odds of me grabbing the handle of that blade, and from about 10 feet, I drop the blade, and I ask you to do what? Now, with one hand, I'm asking you, grab that handle. Because if you don't grab the handle, what's going to happen? Most of the time, look at the size of the blade versus look at the handle, right? Just to be able to grab the handle, there are two things that are going to happen. You're not going to be able to grab it because your brain is going to go, I just can't do it. I'm going to get sliced. And you know, that's one loss. But most of the time, people will go, I think I can do it. I think I can grab this handle. And no, what will happen is that you will catch part of the blade and some of the handle, and you will get sliced. So my advice to all of you who want to get into trading or who want to do anything else, you know, trading options, commodities, any asset class, wait until it happens. The reason I'm showing you guys this today, because once I start showing you guys my charts for the week, there is a lot of this picture happening right now. A lot. All those wonderful uptrends that we talked about last month, right? From Apple's to Nvidia's to AMD's to Tesla's to all that, this is taking place right now. So don't be a hero, because it'll take your account to zero. What I want you guys to do, this is the time to protect what you have made over the last year, let's say. Preservation of capital is what you were playing for now, right? As opposed to gains. Now, some people will be in and out, and whatever, stock jockeys, hummingbirds, fine, let them be. What I'm telling you now is that when there is this much damage done technically to charts, which we're going to talk about in detail coming shortly, you need to have patience now. The first P of the 3 Ps has to come into play. Patience, position, and planning. Patience has to be the most important thing right now for people who go, yeah, I think I'm going to try to catch one of these knives. And then I get sliced and diced. And then to remedy that is going to take you longer than, right, that potentially possible trade, profitable trade. Now, what's going to happen is that there will be bounces, obviously, because nothing goes down forever, straight down forever. However, the idea is, take me as your mentor. Remember these nuggets I'm throwing out to you guys. Don't catch a falling knife. Don't. There's 10,000 stocks out there. Believe it or not, even in a drawdown, there are stocks that do really, really well, which I'm going to show you guys some, right? So study your charts, figure out which ones are outperforming the market. Believe me, even on a day like yesterday or the day before, when the market completely was taken out back and shot, NASDAQ going down 600 points, right? Yeah, if you were an Apple, you got smashed, or Nvidia, or Google, or Amazon, or Microsoft, or Meta. But believe me, there were a lot of stocks that are green, and we're going to talk about that. We're going to talk about my absolutely wonderfully timely advice about 2-3 weeks ago. I mean, honestly, I cannot emphasize enough. If you're new to the channel, go back about 2 weeks. Watch the Power Hour. It's on the channel. It's public. I can't take it back. I don't take videos down. I put them up and they stay there. I talked about what? The rally broadening. Okay. I talked about the S&P 500 and the triple Qs coming down, and rally broadening. And I said we should pay attention to the IWM, which is the Russell 2000. We're going to show the charts. Charts don't lie. Okay. We're going to show the charts and we're going to see if I was accurate or if I was a moron. But ultimately, don't do this. Don't. Okay. Find good setups for you. Even in a shitty market, you can find good setups. Find the good setups that work for you. If you do this, you're going to get hurt more ways than one. So on the next one, I really actually have been paying attention to this for the last 4 years, 5 years, since I really became a believer in Bitcoin. Okay. What is first of all, I've talked about it endlessly in the previous shows. Go back, check out the videos, do a search on the channel under Bitcoin. You'll see what my opinion is on Bitcoin, on MicroStrategy, Michael Saylor, all that good stuff. Here's the deal. Previously, for the past 4, 5, 6 years, when the market took a dive, which it has this week, what did Bitcoin do? Bitcoin absolutely followed it. There was almost like 1-to-1, 100% correlation between the indexes, the stocks or equities, and Bitcoin. Okay. This is probably just started changing maybe a year ago, and then definitely started changing when the Bitcoin ETFs came around. Okay. I clearly now can say that, well, you all know why I believe in Bitcoin. First of all, it's finite, right? It's an inflation hedge, all that good stuff. And to me, it's like, I have Bitcoin. I would suggest Bitcoin ETF dollar cost averaging maybe as well. So a part of it. So let's create a DCA portfolio. Okay. Let's create $100. How do we split that $100? Let's put 50% of it, right, in SPY or triple Qs. So you have the coverage of mega 7s and the best performing 500 stocks in the country, biggest stocks and companies in the country. Let's take $30 of it. So we're up to 80 now. Let's go into a high yielding ETF, right? And then let's take 10% of it, right, and put it into a Bitcoin ETF. So that's how we're going to DCA, dollar cost average. Okay. And then the remaining 10, you can do whatever you want with it. Or to be perfectly honest, what I would do is I would go to like a 50, 35, and 15 allocation. So 50% on SPY or triple Qs, 35% on definitely either high yielding or IWM. IWM is the Russell 2000 because the rally has broadened out. The sell-off has only been in the Mega 7 and the triple Qs, okay? The nosebleed stocks that we talked about endlessly the last 2 months, which, by the way, I had warned that this parabolic thing is going to end badly, and now you're trying to catch a falling knife, right? Don't do it. So that would be my allocation for that $100 DCA account a month: 50, 35, 15, and 15 into a Bitcoin ETF. Meaning, now market took a dive of 10%, so I'm expecting, okay, Bitcoin is going to take a dive. No. What happened to Bitcoin? We talked about this, how Germany government had like brought 1,600 Bitcoin to market to sell because they took it from some drug dealers. As soon as they came out, Bitcoin took a dive from 65,000 to 58,000. But what happened? Boom, it got supported. Money is pouring into these ETFs by the public. It got supported. And guess where we are? Market's down 9% on the triple Qs, about 5% on SPY. What has Bitcoin done this week? Up. It's at 67,000. I'm telling you, Bitcoin has been going sideways for the last 4 or 5 months now, right? Between 67, 68 to 58. Every time it dips, buying opportunity on Bitcoin. But the point I'm trying to make here is the correlation now, and it has ended. Okay, this kind of proves it, that the correlation has ended, and the decoupling, which I call it, is definitely taking place. Okay, if Bitcoin did not tank with all the Mega 7 and QQQs and SPY tanking, and it's holding like a rock here, what do you think is going to do when the market does snap back up? What do you think is going to sell off? No, I think, and I said this on previous power hours, go check it out. I think the sideways action that we're seeing for the last 4 or 5 months now, since February, right, when we took our shot from 25,000 to 72,000, is just this consolidation phase. Remember charts, right? Charts don't lie. All it's doing is going sideways. So when things go sideways, 2 things are possible. Okay, 1, it's a massive top that's going to roll over and die. There are still juries out, but my belief is the other way around. Or things go sideways after a major move to get the weak hands out, right? Get new buyers in, complete equilibrium. That's called collecting energy for the next leg up. I think that's what we're seeing here, okay? And on the next break of 72,000, I think next stop is going to be 110,000 for Bitcoin. So yeah, we decoupled. Correlation is not there, right? And I'm glad to see that, right? And I think we all need to pay attention to all of this carefully. And let's see. All right, so let's take some questions, or should I go to the charts? Let's go to the charts. Well, actually, yeah, let's take some quick questions. And then I'll go to the charts. All right, so there's 12 of you here. All right, so please, share. Please share. I want to get to 1,000 subscribers by the end of by Friday. Well, today's Friday. By Monday, let's say. Vic, good morning. Good morning. Tiger Meg, good morning. Tiger Meg, absolutely. I think DCA is great, but only if you are fair. Nope, I disagree. AA. Young, old doesn't matter, because if you're taking 10% every 7 years, money is going to double. I'm not talking about if you're 80, different story, but even if you're 40, 50, there is no age to do DCA. John, what's up, my man? SCH is a good. Okay, there you go. He's putting one up. I didn't say it. It's his it's his advice. You can still DCA bigger contribution. Yeah, absolutely. There is no time to DCA. There's no time to invest. I completely disagree with that one. Yeah, no, not true. AA. One black swan will not wipe you out if you're doing DCA. You're not thinking of selling. You're not a trader. DCA is not about buying and selling and picking tops, picking bottoms. So I disagree with AA on that one as well. Tiger Meg says September, I think. I don't know what that means. Yeah, the Florida market is horrible. It's actually rolling over, actually, as far as housing is concerned. Yeah, absolutely, definitely. Rentals are good. Rentals maybe getting soft as well, but doesn't matter. It's passive income. Do you think lowering interest rates will? No, prices have gone up as much as they have gone up. Although the risk of lowering interest rates now would be second wave of inflation, which we've experienced in the 1970s. So I'm really watching carefully for that. Absolutely, Tiger Meg, one for all for one. Which brokerage is good for Bitcoin? I don't know. Coinbase is really good. Robinhood is good. But I would do with the, Tiger Meg is expert in this stuff. Use whatever she's using. I mean, what I do is I buy it and then I have a cold wallet. I take it out. I don't leave it on their ledgers, but it's everybody's thing is different. But then you have these ETFs, right? You don't need to do that. You can buy the Bitcoin ETF. There you go. Tiger Meg answered the question. Use a trusted exchange with 2FA buying. Absolutely. Yep. There you go, Tiger Meg. We'll put that one up. Everybody read that. This is great advice right here. There you go. People read this. Tiger Meg knows about that. Robinhood is safe. Yeah, I think they are. Are you going to open the trading club? Man, that's got so many worms in it, ain't Rhonda? I really think one of the best things you can do is start. Yeah, I'm doing that right now. What do you think I'm doing? Uh, DRC, what up, Sergio? Glad you found after hours. Followed Sergio. Okay. By the way, I see a little mistake on the rolling ticker here. If you're going to follow me on, what do you call it? After hour, which shows my stocks for my little Robinhood account. I think my man, Chris, put it as Serge8 STOCK. My ID or my avatar that I created on After Hours SERG, the number 8 STOK without the C. So that's that. How about Coinbase? Yeah, Coinbase is fine for Bitcoin or altcoins or shitcoins. I think we will have a big correction in the next 7 years. You can see that far out? No, I don't think so. I mean, look, corrections are corrections. Things happen. If I dollar cost average with Mag 7, even in, by the way, there is a ETF for Mag 7. It's called MAGS, I think. Don't hold me to it, but check it out. Actually, I'll look at it when I'm looking at the chart. MAGS. Yes, Ayn Rando, that's the one. If I dollar cost average with Mag 7, even in bear market, the gain should. Yeah, but there is an ETF for that, by the way. QBear. You don't need to buy individually all one. They're all, the Mag 7 is basically in there. They had a FANG one, remember FANG? And then they went to Mag 7. So yeah. All right, so let's go to some charts. All right, let's go to some charts. What do we do with the charts? Let's do it. All right, we're gonna do our usual. We're gonna do our usual going through the lists, indexes. First of all, do I think top is in the market? Absolutely. Do I think we will crash? No, but the pullback has been severe. And what is my advice for traders? This is the trading part of the show. Sell every single rally. Rallies are not going to hold until a bottom is built. That's why you don't catch a falling knife. These are the triple Qs. Like today, the market was up over, the Dow Jones is up 650, S&P is up 62 handles. The comp was up about 250. Now it's only up 170, right? So every rally is being sold. I can see it. There are walls of stocks. However, you guys can see I'm like rolling here on my stock finder. MHK is making a new all-time high, which I will take a look for you guys on that while the market's going down. So this is the triple Qs, S&P, daily chart of the NASDAQ 100, right? Which includes the Mega 7. So what are we doing? Like, if you go watch the old power hours, you know, I keep saying the trend is up. I had my trend lined up, short term, medium term, and long term trend. Trends are still up. However, first shot across the bow is short term trend was broken. If you had your trend line drawn, you should be shorting the market right here. When the trend line broke, snap back up. It broke under the 20 EMA, 50 EMA. Now it's kind of cruising towards the intermediate term, which I highlighted, uptrend. If that breaks, which is coinciding with the old high at 450 on triple Q, watch out. Then we're definitely going to test the 200-day, which is at 430. And we may test a long-term uptrend, which goes back a long time, people. So long-term uptrends, got to be careful. That long-term uptrend goes actually, well, there's more uptrends. Like this is the super long-term uptrend going back to 2020, right? And then there's a mega long-term uptrend way down here. And we're talking 200s now on the triple Qs. Will it get there? No. I think if we do break this intermediate term uptrend, we're definitely going to test 420s right about here. I have my lines drawn already. Right about, I would say 414 to 420 range on the triple Qs. So from 500 to 414 or 420, let's say that 80 handles, that's solid 15%, right? So we could experience something like this, but then you guys need to take it as the market gives you. So market's definitely in a downtrend, short-term downtrend. The short-term uptrend is broken. It's under its 50-day right here, 50-day EMA. It's under its 20-day EMA. You don't want to mess with it. Now what you want to do is every bounce up, it's called dead cat bounce. Nothing against cats. I love cats, but that's what it's called. Every bounce should be sold. If this bounces back up to the 50 EMA, 20 EMA, 475, 480, definitely should be shorted or sold until it can prove itself otherwise. So the trend has changed. So be careful. Yeah. So the old high was at 450. I think that's definitely coming. We're at 464 range. We have a little bit more pain to go, but ultimately, I definitely think we're going to test the 200-day average like we did back here in October, November of last year. And if that doesn't hold, then we're definitely in a bear market. So that's the triple Qs. Let's go to the TLT, which is the 20-year note index inverse relationship, right? The rates actually kind of coming down. So if this chart is going up, that means the rates are coming down. It's in an inverse relationship. One thing I'm really closely watching is the super long-term downtrend, meaning uptrend in interest rates. There is this channel that I've been watching. This channel goes back to literally 2011. No joke. So there's that downtrend, right? The channel. We're right against it. That means rates are going to, when the Fed starts cutting rates, this chart will start going this way. Follow my cursor going up. And this is the super long-term uptrend. That dates back to 5 years. This is when we had the zero interest rate policy. Okay. See what's been happening to interest rates? That means the chart's going down means rates are going up. So, yeah, we're at the cusp of lower interest rates. I believe it. That's why rotation is key. You got to pay attention to these things. And I'm going to go, after that, I'm going to go to the spiders, SPY. Spiders are not as bad as the triple Qs because they're more diversified as an index. However, this is like going back 2 years. So I have my lines drawn. I don't have too many lines, but I usually, I have, it's in a short-term downtrend, no doubt about it. It's under its 20 EMA, just breaking the 50-day EMA. Okay, right there, right here. There you go, right there, and intermediate term uptrend. It's right on it. It hit it yesterday. It bouncing back today. I don't believe it. I think it's going to roll over. We had this kind of pullback here before. It held the uptrend twice. It may hold the uptrend. I don't know. That's why I keep telling you guys, you have to be patient right now. You cannot just anticipate a buy and then market gaps down, breaks that uptrend. Next support is going to be at the 200-day EMA, which is right about 502, 503. We were at 565, people, right? So that's about a 12% clip haircut. But then, we held the uptrend for now. The next uptrend that we need to pay attention to is this one right here. I can draw this uptrend here too, but let's take it back a little further, see where that uptrend is going. That uptrend is the one to watch, to be perfectly honest, which is at 440. So did we have pullbacks like that before? Of course we had, right? And this is the pandemic, by the way. And we had more severe one when the Fed started raising rates. I'm circling my cursor here. So market is definitely in a drawdown mood. It could be one of these, but I don't think it will be. I think it's going to be deeper. I think this uptrend is going to be broken. And simultaneously, the 50-day EMA is going to broken. Any close under 50-day EMA is going to accelerate the pain a little bit more, but that's why you don't catch a falling knife. Let's look at some charts. AMD. Okay, let's look at AMD. All right. Okay, so I had an AMD trade. It was going sideways. It broke out. We should have made some money. Since then, what has AMD done? Okay, this is the proverbial falling, catching a falling knife right here. Stock was 188. Today it's at 139. It's sold off 50 points on a breath, literally in the last 7 days. What do I look at AMD now? People are going to go, well, yeah, it's cheap now. No, it's not cheap. It could go down to $100, right? What did it do? Every single time it got to the 200-day average, which I have highlighted, it held and it did well. This time it went through like, hot knife through butter. You guys got to be careful with these stocks. Now, what do I expect AMD to do? I expect AMD to bounce to 150, hopefully, so I can short it. Earnings are coming out on AMD. I'll be careful with it, but I will definitely be looking to short this under 50-day, under the 200, under the 20 EMA, 50 EMA. Nothing positive on AMD. Used to be my favorite. Now I don't like it. Now, here comes my positive, okay? This is what we're talking about. You guys notice the difference between this chart and S&P 500 and the triple Qs, right? What are triple Qs are doing? Going down 8, 9, 10%. S&P 500 down 5%. This is the trade I talked to you guys about 2 weeks ago, okay? This is the Russell 2000. And if John is still here, he will remember our conversation after we had dinner because he's in LA. I had drawn these lines for you guys, the resistance lines, right? What happened? The rally has broadened out. Russell 2000 is completely outperforming, right? The S&P 500 now, after underperforming for the last 3 years. But I said time has come that small caps outperform. Why do small caps outperform? It coincides with the lower interest rate policy that the Fed is going to start following now. Because, believe it or not, interest rates don't affect large companies as much as they affect small companies. So there we are. So this is 5-year IWM, okay? 5-year, 10-year Russell 2000. This is the crash, right? Pandemic. This is what has happened after that. The Russell 2000 is nowhere near its all-time high, while the S&P or the triple Qs have made ridiculous all-time highs. So I'm going to put the same time period for the S&P 500. Look at the difference. Do you guys see what I'm talking about here? Do you guys see what's going to happen here? What's going to happen here now, if you're going to DCA, definitely DCA into IWM. Two things are going to happen. If the S&P 500 is going to go down another 20%, IWM is not going to go down as much, or maybe even go up. If the S&P 500 is going to go up, IWM is going to go more, okay? Because low interest rate policy, this is IWM, 10 years. This is the same duration. This is SPY, and this is triple Q. Look at it, right? These are the same time zones. This is the pandemic. Look what the triple Qs have done. Massive drawdown, obviously, and then all-time new highs, right? What does IWM have done since the pandemic lows? Not much, right? And that's why I put out that trade. I think small stocks or Russell 2000 is definitely going to outperform. So that was the beautiful trade that I gave you guys. And let's look at a few mega 7s. Now, you're going to say, what's doing well, Serge? Well, hey, how about Goldman Sachs? See how different it is, the charts, that when you guys are watching charts? This stock is making almost all-time new highs. All the S&P 500 is selling off, right? You have to find these stocks, though. You have to understand what's happening. Stock is on an uptrend. If you look at the S&P 500 chart or triple Qs, okay, which is this one right here, it looks quite different, doesn't it? Triple Qs are going down. Goldman Sachs is about to make new highs, right? Conversely, let's look at Tesla. What did Tesla do? Tesla broke out. I gave you guys that trade right here. I said August 185s. We're buying at 5.5. They ended up going to 28. If you sold it, I hope you sold it. Obviously, there was a little pump on Tesla that came with the robotaxi. I love Elon Musk, don't get me wrong, but half the shit he says is fake. And I don't have huge hopes about robotaxi anyway. And then earnings came out, huge gap down. Stock is still in a reasonably okay uptrend. Don't hate me if you're a Tesla lover. I love Tesla, don't get me wrong. The only good thing that has happened is that there was this massive, you guys see this pattern right here? This goes back to when Tesla was 20 bucks. You guys need to follow these things. This is called like a massive triangle or a wedge. It broke out. Now it's pulling back. Would I buy Tesla at this price? No. With what I think is going to happen to the market, maybe on a pullback to 200. I don't know. Back to its 200 days. Still above its, looks still okay, but nothing major. It's coming to test its 50-day EMA. I may give it a shot, but not my favorite. And let's look at some, a couple of mega 7s. This is Apple, right? Still hugging the uptrend, just about to break, right? But then I talked to you guys about something called negative divergences, right? So Apple made a high right here. RSI on that got up to about 76, 77. Next time it made an all-time high, RSI did not make that, and then it collapsed, obviously now. Apple, yeah, okay, no big deal. Earnings are coming out on all the mega 7, by the way. Tesla is out of the way. Google is out of the way. But now you got Meta, Microsoft, Apple coming up this week, coming up. Would I buy Apple? Yeah, if it pulled back to 200 range, maybe. For a trade, really nothing really special. And Microsoft, it's kind of duplicate of the triple Qs, right? They're still above their 200-day EMA, but definitely under their 50-day EMA. I'd be really careful catching knives on these. Just let it settle down. And everybody's favorite, NVIDIA. Well, if it isn't funny that NVIDIA is kind of creating this pattern right here. I'm circling it now. The intermediate term uptrend is still intact. Short-term uptrend definitely broken. That's why once my trend lines break, by the way, I take them out. Here's the resistance line, all-time high, but it did exactly what I talked to you guys about negative bearish divergences. Stock made an all-time high at 140-ish before the split, or 1400. And that's where the RSI was, right? And then next time it retested the high, almost came close to that 135. The RSI was never, see, I'm circling it, was never near it. And that shows weakness to me. Stock is under its 50-day EMA. Don't like it. Let it settle down. Although yesterday, if you wanted to trade jockey it, it pulled back into support. You have to have these lines drawn. It came literally down to it about 107.5, and then it bounced 10 points. There's your 10 points if you want to trade it. Intermediate term uptrend is still intact, way above its still 200-day average. Earnings are coming out, bunch of gaps to be filled. Will it get down to, 97 to 100 is a really, really decent buy on NVIDIA. That would be 40 from the top. Is the AI game over? No, but is the bubble over? Yeah, definitely. Bubble is over. People are waking up to it. Let's pull back NVIDIA again. Look at NVIDIA. What is happening is that, by the way, stocks don't get volatile and, too volatile on tops and bottoms. It's happening now. And lastly, what I want to talk to you guys about, which I put out a video, you should go check it out. But quickly, I'm going to talk to you guys about the volatility index. This is called the volatility index. This is an inverse relationship index, right? When volatility goes up, stocks are going down. And do you guys see what's happening? Volatility index was down to 12. It got up to almost 20, right? And then compare now that to the triple Q chart, right? See what's happening? It's inverse relationship. And you guys should put that on your watch list. VIX is the symbol. Definitely watch volatility index going back where the volatility index could go. It could go a lot. I mean, these are crashes, by the way. When the volatility index gets into the 30s and 40s, that's when crashes are happening. And obviously, this is during the pandemic. Volatility index got up to 85. We're only like 17. So people, be patient. That's the P. But on average, if volatility index gets up to about 30-ish or so, 35, that's usually pretty close to the bottom of the market in pricing. So you guys have to understand, when volatility index is 12, we're pretty close to a top, short-term top. When volatility index pumps up to 35, it's pretty close to a bottom. So you can watch this, kind of gauge where things are at. And then next, I'm going to go to a few charts that I'm still watching. One of my favorites, MicroStrategy. This is the Bitcoin surrogate, right? My lines are drawn. Resistance lines, support lines. Here's a support line. This is literally copying Bitcoin, right? But this is like Bitcoin on steroids. And if you have the stomach for it, do it. It's a 1,750 stock, but it's issued a 10-for-1 stock split. So it's going to be coming up next week. It'll be about $175 stock. I think Michael Saylor is a genius. He's mortgaging the company and buying tens of thousands of Bitcoin. I think he's up to 226,000 Bitcoin. That's what the company is made about. Now, you guys are going to say, well, he's crazy. I'm like, no. This is the little stock that I gave you guys, by the way. Remember, Serve Robotics, $2, $2 accumulation. What happened? NVIDIA announced a 10% ownership, and Uber announced 6% ownership. Boom, stock goes up. I had 12,000 shares like an idiot. I sold mostly about in the 8s. Stock, I'll take a quadruple. Stock is 14. It hit 16 and change today. So even on $2 stocks, things are possible. Okay. Do I think the company is worth 16? At 16, the company is $650 million. No. Will I short it? You can't short it. There aren't too many stock, shares to borrow. Let's look at some setups that I think will be reasonable to look at. We had talked about this, like follow Bitcoin. If Bitcoin breaks out, what's going to do well? 2 stocks that I follow, Bitcoin miners, Marathon, right? We even talked about this. Go check the Power Hour. It was in support. I said I would be a trader of this. Go check it out. It's all on the channel. It went from about 19 to 27, pulled back to 20. Still kind of going sideways, but I would be a buyer of Mara right about here, 21.5 range, with a stop at 19. So low risk, good return possibility. The best one out of the whole group is actually called Clean Spark. That's been going sideways like Bitcoin for the last 4 months, okay, since early March. If Bitcoin goes from 68,000 to 110,000, this thing is going to double, triple, okay, because I can pull it back and show you guys what it has done. And they're the most effective, most efficient miner of Bitcoin with a highest hash rate possible. Still in a channel, upper channel, lower channel, support line, resistance line, whichever way it breaks, it's gone. Figure it out, people. Here's one of the ones that I like, Alibaba again. Man, I think the stock is so cheap on a fundamental basis. Technically, it looks like shit, but on a fundamental basis, it's really, really, I think it's super attractive. We keep talking about Carvana. See, market's going down, Carvana's going up, right? You guys got to find outperformers like this. One of the ones that I think we need to pay attention to is super microcomputer that goes with NVIDIA. Now, stock is breaking down, but it's testing the 200-day. Is it going to hold? I'm not sure. But then if you really, really love the company and love AI, will there be a hold here and a rally of 20, 30 points? Maybe, but there are better charts out there. They have to prove themselves. Coinbase still going sideways, just like Bitcoin, just like MicroStrategy. So I'm giving you all the surrogates for those. First Solar was one of the ones that I'm really closely watching. When the market, this obviously had a massive move when Biden announced the restrictions on China on solar panels. You know, watching that. Here's a chart that I kind of watching. Okay, it's called Upstart Holdings. They're like they're not an online bank, but they do loans online with the new AI models and stuff like that. Let's pull it back and see what Upstart can do or has done. In this pattern right here, stock was down to about 15. It went from 15 to 75 in a matter of a month and a half. Last time earnings was a catalyst, gapped up. So this time right here, I am buying the stock here about 26 range. My stop is right at 23. So risking 10% to let it run. Stock does have a crazy run. Stock is extremely heavily shorted. So if I take it back right before it topped, stock was a $400 number, by the way. So definitely accumulating it here with 10% downside, potential 4-bagger. What else? Yeah, I think that should do it. So summarizing all this, please pay attention to not catching a falling knife, people, because you will get hurt. And with that said, let's see if there is any other questions. Any other questions? Let's do this. Okay, let's see. Okay, so where did I leave you guys? Okay, no questions. Questions. I'm out of the market. Good. If you have around 300K to invest now, what's the best way to start? DCA, some of it, not all of it, obviously. You know, real estate, definitely. If you're liquid that much, good for you. Put it in a CD, 5%. You know, park the money for now. If you're going to buy assets, you know, be careful. I wouldn't do in stocks, but I would definitely start paying attention. You know, scale in, scale out, and Randall. You know, don't spend all your money in one place. BTC, ETH, Sol, yeah, okay. You listen to Tiger Meg, she knows more about this. I'm just a Bitcoin guy. I have Bill and USOI and JP. I don't know. Are those some altcoins? DCA on dips, say 100. Yeah, exactly. With $100, where would you start? Futures? No options, no futures, no penny stocks. So all the things you mentioned there, no. Dr. C. Watch the start of the show. Yeah, SPY, triple Q, definitely IWM. Those are the 3 ETFs. But I would definitely put my money in IWM. Is Tesla a buy, Green Brown? No, not at the moment. If you're long term, yeah, I mean, look, man, you know, Tesla has lovers and haters. Technically, stock is garbage at the moment. Fundamentally, another car company. Don't hate me for it. I'll just see I look at the picture. Yeah, don't trade options. $100, no, it'll be below that overnight, unless you get lucky like a GME or something. Tiger Meg, would you recommend charter from previous cycles? Absolutely. History always repeats itself. It always repeats itself because you know, charts are made up by people, right? The Fed has influence in it. It shows greed. It shows fear. It shows exuberance. Tiger Meg, you must watch charts. If you know how to read the tea leaves, you will have a leg up, and that I call that reading the tea leaves. Heard about a new rideshare company to LA to disrupt the rideshare market. From us, no, not yet, Joey B. Well, we will have more about that coming up. Other cryptos such as XRP, yeah, but you know, I would just go with Bitcoin, Ethereum, Solana. I don't know. Just go with the best. I can't recommend XRP. XRP has some fleas. There you go. ETF started this week on Ethereum, just like Bitcoin. More support now. All right, Tiger Meg, thank you for doing this. Any other questions, people? So summarizing, please, dollar cost average, start investing account, $100, $200, whatever you can do, $50 a month, and don't catch a falling knife. Okay. And more importantly, believe in compounding and believe in the power of the markets and DCA. Passive investing will always outdo active investing unless you have experience of 30 years and have been through 3 bear markets, 4 crashes, such as myself. You learn a lot. I'm still learning. So if you guys have any questions, by the way, my email is what? Sergio@sergioavedian.com. Please thumbs up. Please share. Get me to 1,000 subscribers. Please watch the videos. Share the videos. I think I put out really good information. If you guys have questions, email me there. Not the usual email, you guys know. Other than that, you all have a fantastic weekend. Please stay healthy. Be safe out there. Much love. See you guys next Friday. Let's see if anything I said holds true. GME is toast for a while. Yes. Yes, Dr. C. See, you're a gambler, Dr. C. I don't know about you. That can't bounce is not over yet. You know, we'll bounce a couple days now. Go back to the, when we get back to the 50-day EMA, definitely take a crack at it. And don't do like these, don't do 0 DTs, by the way. Okay. 0 DT meaning 0 data expiration. Don't do those. Give yourself a week or 2 or 3, because I think the sell-off has just started. So my final 2 words, I think the market has topped short term. I think every rally now should be sold. If you have stocks that you want to take profits on, pay profits on, please sell it. Remember, you know, I'm trying to be your mentor here. It's never too late to sell, okay? And don't catch a falling knife. So the trend for the last, I don't know, since last November has been buy every dip. We're changing that story now. It's sell every rally now. That's it. Until market proves itself otherwise. Trade what's in front of you. Picture's worth 1,000 words. Don't complicate things. Keep it simple, stupid. Don't have 70,000 charts, you know, lines on your charts. Hopefully you read the books. Hopefully now we're talking the same language to a point. And I'll be here to support you guys. If you have questions, do that. Should we take Wall Street analyst price targets? Absolutely not, Kuber. They will always like lower the targets after the stock tanks, and then they will raise the targets while it's going up. So I'm like, no, don't. Don't do it. Wall Street analysts, they're called sell-side analysts. Their job is to sell. They're never close. Dr. C says, nah, okay. I swing trade, okay. So you don't scalp, you swing trade, okay. Was that big between 2018 and first half of 2021? Now back to 0. Well, I guess that did not work out for you, did it now? Maybe because I didn't have the show then. Maybe if I had the show then, you wouldn't have gone to 0. Why would you go to 0? Yeah, bro, Dr. C. How could you go to 0? At least you should have like stopped the madness. I said this like last 2 months. You have to have a number in your head that where madness stops, computers are off. You know, that's called revenge trading. I can see you doing, I can see from the way you say things, I can see you revenge trading quite a bit. Okay, I got you. But look, we all do stupid shit, right? But do not revenge trade, bro. It'll kill you mentally, physically, financially, every which way. So don't revenge trade. Yes, see you next week, Joey BTV. Thank you, Dr. C. Yeah, man. I mean, it's free. I enjoy doing this more than I do the other thing. And I know about this 10x more than the other thing. So, yeah. Okay. Well, okay. Next time, if you have like a really good pump like that, you just turn the computers off. I come back in 6 months. Or if you have a massive drawdown, turn things off. Go back, go away. Come back in 6 months. Markets open every day. Okay. So with that advice, much love. Stay healthy. Be safe. And next week, next Friday, we'll see you guys then.